The government has been quite busy recently making changes to the tax code, which could have a significant impact on you and your legacy planning for your beneficiaries, including your annuity beneficiaries. Now, the government is still not slowing down with respect to making changes to these tax codes. And again, these more recent proposed changes could also have an impact on you and your legacy planning. So in today's video, I want to discuss some recent legislation that passed into law in December of 2019, and that's the SECURE Act. SECURE stands for Setting Every Community Up for Retirement Enhancement Act. So it sounds pretty friendly, right? But I want to give you a brief introduction about why you need to be concerned about your legacy planning because of these changes through the SECURE Act. Now, this one video in no way will give you all the information on the SECURE Act, and I'll do future videos to provide you more details about the SECURE Act. But for today, by the end of this video, I'll give you an introduction that will explain why you should be concerned about your legacy planning due to tax code changes from the SECURE Act. Hi, my name is Darlene Hartman. I'm a CPA and founder of D. Hartman Consulting, LLC. For the best retirement annuity advice, subscribe to my YouTube channel and hit that notification bell so that you can receive notices anytime I post a new video. Let's start with some background information. So the SECURE Act only pertains to qualified accounts or employer retirement accounts, such as a 401k, 403b, and 457b, in addition to traditional IRA accounts. So I'm going to refer to all of these as Inherited IRA accounts just to keep it simple. Now, all of these accounts are pre-tax. So what that means is the contributions you make into these accounts are not taxed at the time that you contribute to the account, and it grows tax deferred. So I said deferred and not free. So once you start withdrawing money from these pre-tax accounts, you start paying taxes on 100% of the amount withdrawn from the account. So many of you were advised to max out these pre-tax accounts, especially the qualified accounts during your working years. And I'm not talking about maxing out to the extent of the employer match. I'm talking about maxing out to the IRS limit, which in 2021 is $19,500 per year for your qualified account if you're under the age of 50. And it's up to $24,500 per year if you're 50 or older. So many of you have much, if not all, of your retirement savings in these pre-taxed qualified accounts. So why does that pose a problem for your retirement? Well, let's see. Prior to the SECURE Act, your beneficiary would receive from you what was labeled a stretch IRA at the time of your passing. So the stretch IRA enabled your beneficiary to defer IRA distributions over the beneficiary's life expectancy. So by deferring those distributions, the beneficiary was able to take advantage of additional tax advantages on that inherited IRA, in addition to taking advantage to compounding growth. So the stretch IRA enabled the increase in future multi-generational wealth through income tax advantages and compound growth. Leave me a comment in the section below and let me know if you've discussed the changes from the SECURE Act on your legacy planning with your financial advisor. Also, if you're enjoying this video, be sure to give me a thumbs up, subscribe to my YouTube channel, and don't forget to hit the notification bell so that you can receive notices anytime I post a new video. Now, the rules have changed for many beneficiaries due to the SECURE Act starting in 2020. So instead of the stretch IRA for many beneficiaries, there's now a 10-year rule, which means the beneficiary has to cash out that inherited IRA within 10 years. Now, how it needs to be cashed out in those 10 years is currently not clear. So whether it needs to be cashed out by a required minimum distribution schedule set up by the IRS, or whether you can cash it out at any time during those 10 years. But if you don't cash out that inherited IRA by the end of the 10-year period, you could be penalized 50% of what is remaining in that inherited IRA account. So just so you know, that 50% penalty, that is the same penalty if you don't start taking required minimum distributions from your qualified accounts starting at the age of 72. In my next video, I will talk about those beneficiaries that are impacted by the 10-year rule and those beneficiaries that can still have the stretch IRA. So you can see that the Secure Act is not as pleasant as the title may suggest, as this is the way for the government to get access to their share of your hard-earned retirement savings a little bit quicker. So there's a lot of tax planning going on right now between the changes from the Secure Act and the possibility of future tax rate increases. So you've got those people who are converting those qualified accounts in traditional IRAs into Roth IRAs. And if those Roth IRAs are set up correctly within the IRS guidelines, then no distributions from that IRA are taxable. You also have those people who are converting their retirement assets into a permanent life insurance policy so that they're giving their beneficiary tax-free death benefit rather than taxable retirement assets. And then they're spending those retirement assets on themselves before they pass. If you're interested in discussing some tax planning for your retirement or obtaining retirement insurance in the form of a fixed annuity to ensure you financial security, certainty, and happiness in your retirement, be sure to click the link below to apply to become my client. Also, if you enjoyed this video, be sure to give me a thumbs up, subscribe to my channel, and hit that notification bell so that you can receive notices when I post new videos. Also, be sure to share with your family and friends. Thank you for watching. Let's get the conversation started on how you can live your best retirement while not outliving your money.